All right, so let me just actually move on to what we're going through right now and what we should be doing. So for those of us who initially got worried, so this data is in February when the outbreak started. Everyone got worried as to how this is affecting the financial markets. So this is just a comparison of what happened when SARS came, what happened when Ebola came, what happened when Zika came. During the outbreak, all the markets went down, portfolios went down. But 1 year post the outbreak was ended, you had phenomenal returns. If you look at SARS, you had Sensex giving you 83% 1 year after SARS was over. So returns like that are phenomenal, and returns like that are only possible if one is invested in equity through this time. If one either does not have equity exposure or has decided to sell their equity, then these returns are actually not possible at all. Then for some of us who might be new investors, who maybe started investing just a couple of years ago, this was the first crash that they would see. So it would be a very scary thing for them as to they just say started investing 2 years ago and their entire portfolio is -20, -30. So financial crashes are also not an uncommon occurrence. They're actually a built-in feature of markets that volatility will always be there, and after some couple of years, 5 years, 10 years, there will be a big correction. So we look at history from 1994 to 2020. These are a couple of big financial market crises that happened. If you look at Nifty specifically as the index from 1992 to 2020, there have been 19 occasions where we have had more than a 10% correction. So this is not an uncommon incident. What is special about this is that it's happening on a global scale. What is special about this is that it's happening not because of a financial market problem, but because of a health pandemic, and that it is happening very rapidly. So that is the unique things of what we're going through today. Now, if you look at the global market problem, this is data up to 31st March 2020. So even we, India, Sensex, we are at -28% as on 31st March after the COVID crisis began. And global markets, if you see USA, if you see Singapore, if you see Dow Jones, if you see Nikkei, everything is more than 20% in the negative. So it's not a problem that's specific to India. It is not a problem that we're going through because of our economy. It's a global crisis because of COVID. Now, what is most important here? What everyone should be doing? The first thing is do not panic. Why? Because as we just saw, this is not an uncommon occurrence, and this is not a thing that financial markets will not recover from. Once we have the health pandemic part of this crisis over, once we see either a vaccine, once we see some drugs that are working, markets will start recovering, economies will start recovering, and your portfolios that might show -20% today can easily show +20, +30% in the next couple of years. So there's no reason to panic, and there's no reason to actually sell your equity investments. As very rightly said here is, do not convert your notional losses into actual ones. Right now your portfolio might be in the red, but that loss will only be there if you sell today. If you stay strong, if you hold through today, 2 years in the future, your portfolio will be giving you handsome returns. The second point that a lot of us might be having is, what should we do with our SIPs? So the whole point of SIPs is that you invest every month, whether the market is up or down, so that you're able to get greater units when the market is down. So this is actually the best time for your SIPs. And rather than stopping them, you should take this opportunity to actually increase your SIPs if it's possible. If you have additional liquidity, you should be increasing your SIPs instead of stopping them.
So one should go for, right now, one should go for lump sum or SIP? Which one is better?
So I'm just covering that in the next point.
Yeah.
So what you should do is, so generally as a policy that we follow at SMFS is, we do not recommend lump sum investments in equity because equity markets are very volatile. So we recommend either investing through SIPs or through STPs. However, when markets correct like this, so in February, basically Sensex was close to 41,000, 42,000, and today we are looking at Sensex at 31,000, 32,000. When markets correct so in such a substantial nature, we can look at lump sum investments. However, what is important to keep in mind is that 32,000 Sensex doesn't mean that we can't go lower. In March, the last week of March, we actually reached 25, 26,000 at Sensex. And maybe even that's not the bottom. If the virus gets out of hand, the Sensex, which is at 32,000 today, maybe even might drop as low as 24, 23,000. So that's why, even though it's the correct time to make lump sum investments, What we recommend is that you make it in 3 to 4 tranches. You stagger your investments. So suppose you have the capability, liquidity to invest 2 lakhs in the next 2-3 months. You divide it into chunks of 50,000 each. Invest 50,000 today, wait for a couple of weeks, see how markets are moving, invest 50,000 again later. And the even better way and more disciplined way to do this actually is something that's known as a systematic transfer plan. What that means is you invest those 2 lakhs in a liquid fund, and every week a portion of that from the liquid fund will be invested in the equity fund. You do this over the next 4 months, so maybe 20 weeks on an average. So you've invested throughout this volatile journey. You've invested whether Sensex is at 32, whether it goes lower, whether it goes higher. You've deployed your cash in an averaged out manner.
Shrey, if someone has invested in Franklin smaller companies funds, now it is 20% down at that time. So one should switch this amount, or we should wait for that?
So there are 2 things that you need to keep in mind. Number one, when you say Franklin smaller companies is negative 20%, you should compare it to other small cap funds. You should see what HDFC small cap, what Reliance small cap, what Nippon, what Axis small cap, etc. are performing. So whenever you judge the performance of a fund, you should judge it based on the other funds in that category. The second important factor to remember is why you invested in the small cap fund to begin with. So if you were investing in a small cap fund, what we recommend is that you should have a time horizon of at least 7 years. So if you've invested, say, just a couple of years ago and you want to exit the small cap category, that's not recommended. However, as I said, if you look at the other peers in the category and they're performing well, you can always switch from Franklin small cap to, say, HDFC small cap or Axis small cap. I hope that answers the question.
Yeah, thanks.
Yeah. So just the last point that I want to leave everyone with is we covered why asset allocation is important. The second point is it's important to review your asset allocation periodically, especially when we're going through a chance like this. So suppose one was following an asset allocation of 80% equity, 20% debt. When markets have corrected substantially, your equity percentage would have gone down because your equity valuation would go down. So your current equity percentage might be, say, 75%, might be 70%. At this time, it's recommended that you shift some part of your debt to equity, get your asset allocation back to 80-20. What this does is that you're investing in equity when it's low, so that you reap the benefits when it rises. And similarly, when equities do well, 2 years from now, 3 years from now, your equity allocation from 80% becomes 90, 95%. At that point of time, it is equally important to get back into debt to book your profits, because you don't want to wait for markets to correct again. So that's why asset allocation is quite important. And I'll leave you with that.